Hello, Maverick traders. Welcome out to initial public offerings, what is called an IPO. So, when a company initially goes into the public, we're going to talk about what's happened, but I'm even going to take you back a step and talk about kind of the ability to build something from nothing. And so, there is a saying that it takes money to make money, that you have to have money in order to build something, and that's not really true in business. So, let's talk about an idea here. An individual comes up with an idea, and it can be any number of ideas. They want to sell something, they want to offer a service, whatever it may be. Purely the idea and a little sweat equity, they could literally start with $0 and build something that can be worth trillions of dollars over time. And the way that they do that is they tap into a couple of markets. If you have the idea and you're willing to put in some effort, you can either take on debt or you can find people that will give you money to start this business. It probably does take some money to start, right? But you could start with debt or you could sell equity. And so this is still in the private markets. Let's say all you have is an idea. Well, if you take on debt, it's probably going to be guaranteed against you as an individual and so on. So there's a cost associated with that. Let's say that you think it's going to cost $20,000 to start. The good thing about selling debt is that you can repay it and then you still own 100%. See, it's my idea, it's my business, I own 100%. Taking on debt is not giving away part of the ownership, it's just borrowing money. As soon as I pay that money off, it's done. They go away, and I still own 100% of the business. But instead of debt, maybe I take on an equity partner and I say, okay, if you give me the $20,000, I'll give you 20% of the business. So now they might be willing to take this risk. I can literally start with nothing and have nothing guaranteed and so forth. If this business fails, they're out the $20,000. If it flourishes, they own 20%, but this is their risk. Now, an equity partner takes away some of your upside, doesn't it? Now I only own 80% of the business, and maybe over time we need to acquire more funds to get this going. Maybe we both have to sell some equity or we have to take on some debt. There may be required new investors or we might need more capital. If you've ever seen the show Shark Tank, this is really what's happening. Is somebody has an idea, a concept, a business, and they go into the Shark Tank, and there's Mark Cuban and all these guys, and they basically give their thesis of here's why it's going to work and here's what we're doing so far and usually they're selling equity. They say, okay, for $100,000 we'll sell you 20% or something like that. And so they're willing to give away equity for the capital they need. And the shark says, okay, well, we'll send you $100,000, or such and such an amount for such and such a percentage. And you'll notice that the questions they always ask is related to, well, what's your revenue? How much have you earned? This in trading is called EPS, earnings per share. These are measurables where they can see how the business is doing. They'll say, okay, and they'll negotiate for equity. Every once in a while, they'll do some sort of debt offering. But most of the time, the sharks want equity. They want the upside. Because if they invest some money into this business and then it grows into the next multi-billion-dollar corporation, that 100,000 that they invested can turn into tens of millions of dollars, right? So you have unlimited upside for the investor and limited downside. They can lose 100K, but they can make, literally infinite amounts of money. And so this is kind of that process. Well, an initial public offering, so there's a few important words here. We're initially offering this to the public. This is the first time, right? We've done private placements, we've done different things along the way. But if we're big enough that we can take it public, that means we probably have some real revenues and earnings, and we've been in business for a while, and the market wants it. The market has an appetite for investing in this business. And most any company every company that's currently traded, and even some that are not, have gone public. Sometimes a public company will go back to private. That's what happened with Twitter when Elon Musk took it over. They basically went private. And in a couple of years, they'll offer. They'll do another offering where they'll come back to the public. I'm quite sure of that. That's what they tend to do is they take it private, they try to fix up the business, they try to get it working, and then they offer it back to the public, and the public says, we want it, and they pay a huge price. And that's kind of the idea there. So an initial public offering is the first time they've come to the public and they've said, we're selling. And in most cases, they're selling a huge percentage. So this original owner, his ownership might be down to like, 40%, let's say. And that might be high given he had to raise capital. But let's say he owns 40% or half the business or something. When they go public, part of the reason they do that is these original people that had all the risk, maybe all their eggs are in one basket. Maybe this guy started this business and it's his life's work and he's been at it for 20, 30 years, and it makes sense at some point to maybe diversify, to say, well, what if this business failed? What if we got into hard times? I have everything I own tied up into this business. It's a way for them to cash out. Now, they might decide to keep some. They might keep a little percentage or whatever and have 5% of the company going forward or something, but they cash out, and basically all the cash goes to them because they've sold the business. Now that 35% gets sold to the public. So I go in and buy 100 shares, and you buy 100 shares, and somebody else buys 100 shares, and so on and so forth. And the public basically acquires that business. Institutions, hedge funds, mutual funds, they're all potential investors in this business. And this is the offering. Now, there's different types of initial public offerings. Usually, they kind of set a price. They put it out there, and you can invest in this as it's going to the market, and there's a certain amount of demand. And if the demand for the stock is high enough, they have kind of a set price where they think it will price, and they say, well, we expect it to price around $35 per share or something. They kind of give a range of expectations, 30 to 35 or whatever. But if demand is strong enough, it might open where people were willing to pay 45. And that's where it first opens if the demand is strong enough. Basically, it's kind of an auction type system where big institutions have basically kind of taken this to the market, and they're trying to price it, and they're using comparables. They're saying, well, this corporation does something similar. It's kind of like real estate. You look at the other houses that are similar to this house in the similar, zip code and so on, and you say, okay, well, this one should be worth about this. That's kind of what they're doing. They try to figure out where it should be priced, and they do a pretty good job at that, but sometimes it will end up quite a bit higher, or it could be that there's quite a bit lower, that they thought it should price at 35 and there's just not demand, and it opens, quite a bit less than that, or trades down pretty significantly right out of the gates or what have you. So they try to get that right, but there's a very volatile nature around an initial public offering, because this is the first time that the public has kind of had a chance to really buy this stock, and that might be a good thing or a bad thing. The demand might be stronger or weaker, and so they try to take companies public in a strong economic environment. In 2022, we've had way fewer IPOs than we had in 2021 and 2020 and so forth, because the stock market was booming, and then what's happened in 2022 is, well, we've been busting, right? And so 2022 has been an ugly market. Higher valuation stocks have been hit the hardest. Those are a lot of the company growth stocks. In other words, those are a lot of the companies that are going to go public. They've been in their growth phase, and they're exciting, and they have great potential. But those are the stocks getting hit the hardest. So this has been a very slow year for IPOs, and we're right at the end of 2022. Going into 2023, if the market recovers, and actually we just had kind of a bounce back right towards the end of this year. I noticed there were a few IPOs that were just coming out. Companies basically saying, hey, here's our chance. The market's stronger. There's an appetite for buying stocks right now. Let's take them public right now. So they're kind of in that wait and see mode of whether the market is good enough. You don't want to come in and start selling houses when the demand for housing has just collapsed and housing prices are falling and so on. You want a strong market because you need those buyers, right? And so when a company goes public, the first thing you'll see on the chart is, well, it's the first candle that you've ever seen, right? It'll trade that session and there's no prior history. So technicals, charting becomes basically impossible. And if you're a chartist, you basically have to wait until this establishes some form of history before you can start to see anything significant, right? Trends, support and resistance, moving averages, none of that will show up on the chart when it first goes public. The fundamentals are all what it was doing in the private space, right? Those we can look up. We can say, okay, how well has it been doing? What was its year-over-year growth? How did it do in revenues? All of those numbers you can actually look at. There's also no options or anything like that traded. It takes a few weeks usually before the options come onto the market. So somewhere out in here is when they'll finally open up options. And as you would guess, when options first open up for trading, do you think liquidity is sky high? Do you think there's tight bid-ask spreads and so on? Of course not, right? It's kind of very, very wide. The bid is way out here and the ask is way out here, and there's enough space between them that you could drive a semi through. And it's just not a great environment. So IPOs are tough in that there's really no technicals, there's no options, there's a bit of history to it, certainly, that we can look up the fundamentals, but that's it. There's no behavioral stuff. We can't see, there's no overhead supply and underlying demand. There's nothing that we kind of can analyze in that fashion. So a lot of times investors and traders will kind of have to just allow the stock to trade for a while before they even become interested in it. All right, so if I bring you over, now this is my personal Fidelity account, and we don't have IPO trading at Maverick. We're not in the IPO business, but on a personal account, you could actually set up IPOs if you were interested in this, and not just IPOs. A lot of times these are secondary offerings, and we'll make a separate video talking about that. But if I click on any of these, like I get notifications in case I want to invest. Now it'll tell me a little bit about what this company is, and I can read the prospectus and so on, but this is a secondary offering. Let's see if there was one that was an initial public offering. Acrivon, I think, was. Okay, so here is, see how this is an initial public offering, not a secondary offering. Acrivon Therapeutics, it's in the healthcare space. They're selling 5,900,000 shares. Expected price range between 16 to 18. And again, this is dictated by supply and demand, but that's where they're expecting this stock to price on its IPO. Pricing date, November 14th, so on and so forth. So you have to put in an indication of interest. If I wanted to get in on this, which I didn't, but if I wanted to, I could have come in here and read the prospectus. I could have said I'm interested. I could have said how many shares I wanted to buy and what my limits were, how much I was willing to pay for that. Maybe I thought it was going to price low or whatever. I can basically get in on that offering. Now, when it prices, assuming that I said I was willing to pay 16, if it prices at less than that, then I get that lower pricing. I get whatever again, everybody gets that same price at the pricing. So let's come over, this was called Acrivon, okay? So let's come over here and we say Acrivon. Okay, so Acrivon Therapeutics, there it is. And this thing went public back in November. You can see they priced it November 14th, and then it went public the next day. And here's a little bit of information. So it basically priced not just at the low end of the range, it priced below the low end of the range. So someone might say, well, you could have made some money. They do frown upon you quickly selling your IPOs. If you don't hold them for at least 30 days, a lot of times they won't let you invest in them. They don't want you to just trade it for the pop. You can get away with it a couple of times, and it doesn't always happen, but theoretically, I could have gotten in on this IPO and it would have priced at 13 or so, well below the expected range between 16 to 18. But then it went public and it shot up, and maybe I sold into that, made a couple of quick bucks. Well, again, they might ban me basically from the brokerage of doing IPOs if I do that. They want you to hold them over 30 days and not just play it for the pop that's possible and so forth. They don't want you day trading these in essence. And if you do that too much, they probably won't let you participate. But anyway, you get in, it went up into the pricing range and even beyond that. This speaks to the volatility of it. And then it came cascading right back down. And notice we've just leveled off at 12.5, a little below where it priced at the IPO. We have no real track record, no real history. We know that they were expecting it to price here. It's worth considerably less than that. Is that a value? Well, there's a lot of question marks as far as that's concerned. If we go back to history, one that I really remember was Meta, which formerly was known as Facebook, and we got to go back quite a few years, but this is one that kind of stands out in my mind because it got so much negative publicity. When Facebook IPO'd, we can go back a few less years, make this a little tighter. When they first went public, if you look at some of the price labels here, let me draw a line over. When this thing first went public, it priced at like 40, well, it looks like that's maybe 42 or so per share. And that stock, well, maybe it was a little less than, no, that's probably about right, 42 or so. And that stock immediately was a disaster. The public was very interested. It priced above the range, and that thing went through a free fall. For the first couple of months, it was on the news a lot. Oh, they screwed this up, Mark Zuckerberg this and that, and so on. And you got no pop. If you were trying to play it for a pop, all it did was drop and drop some more. You saw your investment go from 40 to 17. Well, lo and behold, Facebook took a while, took many months, but it went on to amazing feats, right? Huge upside, big recovery. Now it's collapsed some recently because they've really transitioned their business from what they were doing into this big meta space. They changed their name, and about the time they made these big switches and big investments is when this stock started to collapse back down. But that's kind of an interesting one. That was a failure initially. Now Uber and Lyft and some of these others went public. Now Uber went public at 36 or so. Initially kind of popped a little, dropped some more, huge disaster. Went on to zoom higher and now right back down. There's all sorts of, pops and drops and things like that. Twitter actually went public. Well, I guess I can't pull that chart because they went private, can I? There is no chart anymore. But Lyft, another huge disaster, went public, basically collapsed from that point on. This is to just kind of show you that they don't always pop right out of the IPO. Now, sometimes there's a huge pop from the IPO. When Snowflake first went public, they were pricing, somewhere here in the 200s. And within the first few months, it ran to the 300s and 400s. Now it's collapsed from there, well below IPO price, as you can see, since that period of time. So there's all sorts of shapes and sizes. There's no guarantee there's going to be a pop or a drop. The one thing that's very clear is that there's a lot of IPO volatility, that the stock will move in dramatic fashion. For us, if we're looking to, really look at the charts, maybe trade options, do a variety of different things, we somewhat have to let that first period of time go away, let the options come onto the market, let them build up some liquidity, and then at that point you can start to trade it, and there will still be plenty of volatility in many of those names. And at that point, it's publicly traded, it's owned by the public as shareholders. The CEO, CFO, COO, they work for you, the public, the shareholders, and it's tradable from that point on. So with that, I hope you've enjoyed this class on IPOs and learned some new ideas and elements. If you want to get into them, you can potentially do that through a personal account and set up IPO investing. As always, we just enjoy the process of learning, of teaching, of growing together. So thanks for joining us. On behalf of Maverick Trading, I'm Corey Halliday, and we'll see you next time. Goodbye, everyone.